Hey guys, Mike here again. Wanted to do a video on Foot Locker. I've been looking at it a little bit this week. I didn't buy Foot Locker. I don't have plans to buy Foot Locker, but I'm going to start doing videos on just recording my thoughts on stuff that I've looked at and just to record my thoughts so I can check them later. I'm still going to keep researching this one because there's a possibility it's interesting, but I'll just give my basic thoughts on it here. So in a nutshell, this is a real, to me, this looks like a really classic cigar butt type investment, trying to figure out if there's one last smoke left in this thing before it basically moves towards oblivion. Now, my overall thought here is I think that this is a race situation. So they have huge buybacks planned. But it's a race between the buybacks and the sales declines over time and the secular decline in retail. So it's possible, I think it's possible that the buybacks win this race and that there is another smoke left in this cigar. But I think there's some fairly chunky risks that are scaring me away from this. Okay, so just an overview of the company here, what's going on right now. Everyone knows that brick and mortar stores are, up against the wall right now. People are moving to direct-to-consumer models or just online shopping. And so Nike has made up, in the past, up to 75% of their sales, and Nike's been moving over time towards a direct-to-consumer model, and the company is expecting that in the next year, there's somewhere between 55 and 60% of sales. So that's what scared the market recently, and that's what caused the last downdraft in the stock to about $30. I was also reading that Adidas has the same plan over time to move more towards direct-to-consumer. They were talking about 50% by 2025. So that's another big brand that they carry that could hurt their sales in the future. So I'm not going to go into a lot of the rest of the company, but that's what's going on right now. The company has guided, this year the sales might be down about 5%, and the gross margins are going to come down to about 30%, just over 30%, from 34% last year. So the financials from 2021 for me aren't that relevant. I'm going to look at the 2022 estimates here, which are about $4.50 earnings per share and probably about 400 million free cash flow. So that's my sort of basic belief that I'm working off here. I'm not looking at 2021 numbers at all. So for people who want to buy this stock and people who have bought it, I believe that the real argument here is the buybacks. They have been buying back quite a lot of shares. So they bought 375 million back in 2021, and they have another 1.2 billion authorized. And so that's a very big chunk of a 2.8 or 2.9 billion market cap. So that's potentially up over 40% of the stock that they're going to be able to buy back over the next few years. If we use the estimate of, let's say, 400 million free cash flow in 2021, they need 100 million for their dividend, which leaves another 300 million for buybacks. So that's about, like 10% of the shares that they're going to buy back. Plus you have the 5% dividend that's sitting there. And that on the other side of the race, so you have the race of management, which is buybacks and dividends. And the other side is the sales decline. So they look like they're guiding at 5% down for the year. So right now, if this all goes to plan, you're probably up 10% on that deal. And maybe the stock even reprices upward a little bit in terms of the multiple. Now, the problems I see are, well, first of all, the multiple. The market hates stocks that are shrinking. They hate sales declines. The market hates when there's no light at the end of the tunnel, right? So this is currently trading at about 7 times free cash flow for 2022. Now, I wouldn't bank on that multiple going up if everything's continuing to decline by 5% a year. It might even go down. You might even get a 5 times multiple due to the worries. So I don't think that there's, I wouldn't bank on a multiple expansion unless you get just even a quarter where sales beat the estimates and the growth rate beats the estimate. Kind of like Facebook, Meta, the quarter one estimates were so negative that even a decent quarter, or like even beating these bad estimates, has propelled the stock up, I don't know, 20-25% now. So you might have a situation like that. For me, the bigger risk is a recession type situation, because in this race you can't really afford any downtime, because if you have, let's say, a year or two where cash flows come down because there's a serious recession, that just basically you come out the other side and sales are permanently lower, and you haven't had the last year or two of buybacks. And in a situation like that, you could end up with a share price that gets crushed even more than it's already been crushed. And I personally wouldn't want to sit in the stock hoping for a recession to end. And incidentally, we did see a GDP contraction in the US of 1.4% in the first quarter. I believe that's what it was, of this year, 22. And that looks like it's probably inflation related. So it's very possible that we have another quarter like that and people start tightening their belts all over the place. We might actually be in a recession already. All right, just a quick look at the financials here. Balance sheet looks reasonably okay. There's a net cash position of about 400 million. Not much debt. But if you include the leases, which are, 2.4 billion, then you might end up with, if you treat those as debt, then they might actually have a net debt position of about 2 billion. So then you're looking at an enterprise value of closer to 5 billion, which might be what we want to do to be safe. In terms of the income statement, they're talking about a 5% reduction in sales this year. So maybe that's like 8.5 billion in sales. Now, the past income statement, I said I'm not going to bother with that. The company's guided that their earnings will probably be about mid fours. So we'll use that number. And just a quick calculation on, if, let's say, they were able to buy back 1.2 billion of shares over the next 4 years, then that would put earnings maybe at around $7.75 per share at that time. And if for some reason you have a good quarter and the multiple goes to 10 times earnings, then that would imply about 150% upside from $30. So I would say that's the upside here. But again, if my concern is that we're potentially in a recession here, and companies like this might feel get squeezed here. And so in that kind of situation, I feel like the stock could probably drop 50% or more. So bottom line for me is this is not a sleep well at night stock. It might be an exciting stock to have because you get to, you're going to get a result probably in the next year or two. You either get a big move up from beating expectations and buybacks working, or you get another further contraction in earnings and the thing crashes. I'm going to keep researching this one because maybe I've assessed the risk incorrectly. I'm going to keep looking to see if maybe I've done that wrong, or I've got something else wrong. Because I do like the buyback levels. I'm really a sucker for the big buybacks like this. So I'm going to keep looking at it to see if I can find any other angles to look at this from. But at the moment, it's not a no-brainer for me. I don't want to buy in here. It doesn't look like free money. And maybe if this thing fell to $15 and we had a real Fed-induced recession here due to higher interest rates, we might get into the no-brainer territory if it's trading at half the multiple it is now. But anyway, that's where I'm at with Foot Locker. If you think I've missed anything or disagree, feel free to comment. And thanks. I'll see you in the next video, guys.